Good morning. It's a pleasure to be here, and I'd like to thank the Bundesbank and the German Finance Ministry for inviting me to this event. I'm going to talk about the importance of the non-bank financial sector in the United States. What I'll say won't be fully relevant to Europe because, as Martin Hellwig already pointed out, the euro area financial system differs from the US system because the relative size and the role played by banks is greater in Europe or in the EMU than it is in the United States. The numbers, by the way, on non-bank sector are very hard to figure out. You get two totally inconsistent numbers, and then you have to do a lot of work trying to find out what they relate to. But there's a recent report by the IMF which says that banks in the euro area account for roughly 75% of total lending by banks and non-banks, whereas in the United States, the banks in 2013 accounted for just under half the total of lending. In a few minutes, I'm going to give you some more data which I think are more accurate. You know, the role of the non-bank financial institutions in the United States brings with it both economic benefits and risks to financial stability. And I'll talk in a while about the risks that could be seen clearly during the global financial crisis, in the propagation of which the non-bank sector played a significant role. The non-bank sector in the United States was not always so large. It grew particularly in the 2 decades between 1980 and 2000, and it's by a set of data which I believe better. It's more like 40%. It was in 1980, 60% banks, 40% non-banks in terms of credit granted, and it's now the numbers have switched: 40% banks, 60% non-banks, and it's been constant for about between the beginning of this century and now. It's been constant. It hasn't been constant during that period. So I'll describe how non-bank intermediation in the United States has changed, what regulations are in place, and what reforms are underway to address the risks to financial stability associated with the growing non-bank sector. Many of these things being led intellectually, or at least contribute to significantly intellectually, by the work of the Financial Stability Board. So I'm going to start by reminding us of material we all know. If we all know it, it probably is right, but may well not be. But since we'll share in the errors, we can all feel much better. First, the provision of credit to the non-financial business and sector and households is critical to a well-functioning economy. We know that particularly because of Ben Bernanke's research on what happened in the Great Depression, where it had been accepted that it was the collapse of the money stock that resulted in the financial crisis, but the more detailed work done by Bernanke put his finger on the collapse of the credit mechanism as the critical factor in the worsening of that crisis. Secondly, the banks have a very straightforward business model. They take deposits. I mean, according to the textbooks, they have a straightforward business model. They take deposits from customers and make loans to businesses, households, and governments. So they have this maturity transformation, which makes them vulnerable to runs. And in recognition of this vulnerability, bank deposits became insured, and the lender of last resort function, which by budget was actually related more to panics within the financial system, not particularly in banks, the lender of last resort function was extended to dealing with bank loans. Third, non-bank financial institutions also act as intermediaries. The data that I just gave you, about 60%, 40%, and the reverse are from the financial accounts of the United States. That is the flow of funds data, probably more accurate than the IMF's data that I quoted at the beginning. The institutions that rose in the 2 decades following 1980 were the government-sponsored enterprises, particularly Fannie Mae and Freddie Mac, and mutual funds. And those were the two that increased most rapidly. Insurance companies had been the main, insurance companies and pension funds had been the main non-bank institutions in 1980. They are now relatively smaller than they were then. We're looking at a group of entities, insurance companies, finance companies, GSEs, hedge funds, security brokers and dealers, issuers of asset-backed securities, mutual funds, and money market funds. They provide credit through markets or by extending loans directly to businesses and to households. They evolved alongside banks, and their activities are in many respects intertwined with those of the banks. Indeed, for every activity conducted by banks, with the exception of taking government-insured deposits, a non-bank financial institution likely conducts a similar activity. In many cases, they engage in maturity and liquidity transformation and are levered. So they have vulnerabilities similar to those of banks, but they lack the benefit of access to a lender of last resort. Even on the payment system with which we associate the banks, non-banks are also involved, and they're connected because banks finance companies in the non-bank sector. They provide, they use derivatives, sometimes via the non-bank sector, and the many other services provided by banks to non-banks and the reverse. And in addition, and this matters in the United States, where the Fed is the regulator of bank holding companies, many non-banks are owned by bank holding companies, which may provide capital and liquidity guarantees to non-bank subsidiaries. So all this increases the complexity of the financial system. The simple transaction that I described of the bank taking deposits and lending them out is a one transformation action. But in the modern world, a bank might originate the same loan, but instead of holding it on its balance sheet, it could securitize it. And the resulting security might be purchased with the help of short-term funding provided by a money market mutual fund. And if it were, it might not end there, because now that mortgage-backed security might be sold and repackaged into several new securities, which could also be insured by financial guarantors or through credit default swaps. And so in this example, what had been one transaction can become, if you follow the story I told you, which would be amazing, by at least 5 transactions, and it couldn't be many more, and the people involved would not realize what the whole chain was. And if you have more transactions, you have more points of vulnerability frequently. So we also have the non-banks undertaking maturity transformation, and a few of them can obtain advances from the Federal Home Loan Bank system, which is in effect for them a lender of last resort, but most of them do not have access to a lender of last resort, which means that in a crisis, their difficulties are greater than those of the banks, and that could reduce the availability of credit, cause fire sales of assets, leading to impaired market financing, and because they are related to banks or connected to banks in many ways, a shock to the non-bank financial sector can threaten the stability of the overall banking system, as happened in the unfolding of the global financial crisis. Now, what I want to do now is explain just how much the recent financial crisis in the United States was a crisis that developed in the non-bank sector. Now, I'm not going to focus on the role of the banks, but the role of the non-banks was absolutely critical. Some of the first cracks in the non-bank sector appeared in April 2007, when the second biggest subprime mortgage lender in the United States filed for bankruptcy after its creditors pulled back on fears about its losses. A few months later, with subprime assets falling in value, money market investors refused to roll over asset-backed commercial paper that had been funding many of these subprime assets. And with this market shrinking dramatically, the banking sector was left on the hook to support entities that banks had sponsored or to which they had provided some form of liquidity or credit support. It used to be said, I'm sure you remember this, that the development of securitization and other things put risks where they were more appropriately put. Well, it turned out that they were put there, but they were parked there temporarily because they came back to the banks. And so that turned out that improvement in the allocation of risk was not as fixed as it seemed. At about the same time, the subprime crisis got underway, and remember that we were assured repeatedly that it was a small thing. Bear Stearns, then one of the 5 largest investment banks, liquidated 2 of its hedge funds that had invested in mortgage-backed securities, including collateralized debt obligations, which is another link in the chain of transactions. And in March 2008, as you recall, some creditors stopped financing Bear Stearns, and forced asset sales put additional downward pressure on asset prices. Now, Bear Stearns was not a bank. And so, big institution, not huge, but big, is a critical link in this chain. Then came the dramatic month of this crisis, which was September 2008. The chain of interconnections with these non-bank intermediaries had helped spread the financial pain, and a lot of firms were caught in the financial maelstrom. But then, Fannie Mae and Freddie Mac entered conservatorship. Lehman Brothers failed when its creditors ran from it as they had from Bear Stearns. AIG had to be bailed out primarily because of its inability to post enough collateral to cover liabilities on credit protection it had sold on many entities, including Lehman, and because it had lost funding in the securities lending market. Sometimes when you ask about insurance, have insurance companies failed? There's an Australian example, but I see Glenn is not here to tell us exactly what it was, and AIG, but AIG was not engaged in any clear sense in its normal insurance function in the failure. And then, just in case that wasn't enough, a money market mutual fund at the end of the month broke the buck, which meant it couldn't maintain its $1 redemption value, as a result of holding Lehman securities. All the institutions I mentioned are non-banks, and they played a very important part in the development of the crisis. The banks were not immune to the financial market stress, but they were far less involved in the unfolding of the crisis than were the non-banks, which illustrates the importance of the non-bank sector and the vulnerability of the financial system to the distress of that sector. It was when non-banks pulled back, other parts of the system, including banks, suffered. Now, what has been done subsequently? Sorry, before I get there, I just want to mention one other thing. There was an earlier case of a non-bank intermediary creating a near crisis, and that was long-term capital management in 1998. You might have thought that would be a warning sign, a signal to take these issues very seriously. But I don't think there were any major changes in regulation at that time. That problem was dealt with in the normal manner. You got a bunch of people who you're going to put, who you could persuade to rescue LTCM, and it did not have to declare bankruptcy. And that seemed to be the end of that. And so that warning sign was not important. But the warning signs, there were no warning signs. The disaster of the global financial crisis was bound to produce widespread regulatory changes. It was clearly necessary to strengthen the banking system, necessary from the viewpoint of financial stability, necessary also from the viewpoint of what the public sector and what the public was willing to put up with in future crises. That is, the impression being given that the banks had been, that Wall Street had been rescued, but Main Street hadn't. And with respect to the non-bank financial sector, there was a clear need for greater transparency, less leverage, and more stable forms of liquidity transformation. Now, there's an important change also to the banking sector, which was the adoption of a macro-prudential perspective to supervision as regulation. In the 19-somethings, 60s and 70s, there was a professor at Princeton, Fritz Machlup, who analyzed almost everything through etymology, that is, definitions of words, and you could look at the words and they all had slightly different meanings, so forth. I think macroprudential, I don't believe in spending a lot of time on etymology, but I think we are using macroprudential in several senses. Macroprudential, when it was first introduced, was something that said there are systemic interactions and you have to take them into account in supervising the system. And the systemic interaction was these systemic interactions, which were those that derived from the failure of Lehman, a medium-sized financial institution which had global impacts of almost unprecedented severity. I remember as a student reading accounts which went like this of the Great Depression. Kreditanstalt failed in Austria, and then apparently the world blew up, and you kept saying, well, even then Austria wasn't a great financial center, so what did that have to do with that? Well, here Lehman Brothers failed. It wasn't a great financial center. It wasn't a great institution. But boom, there went crises where you could see on almost within a month, huge impact on trade. If you look at the exports of the major Asian exporters, they went down by 30% over 6 months. This is a remarkable transmission of the impact of a financial crisis. Now, this on macroprudential in this sense of systemic interactions, I think the Federal Reserve has taken that definition of macroprudential into account by setting up what is known as the LISCC, LISCC, the Large Institutions Supervision Coordinating Committee. It's a coordinating committee which looks at regulation and also in the stress tests examines the interconnections of the largest banks and other systemically important institutions. So the LISCC basically looks at the SIFIs, including the non-bank SIFIs, as a group, and there is a macroprudential. There's been a shift in the macroprudential direction in that sense. But we use macroprudential in a second sense, and I think it's developed over the course of time. I think it's a non-interest measure that deals with some aspect of financial stability that one day might be systemic, but not necessarily is systemic at the moment. For instance, the Federal Reserve draws attention to the rise of leveraged lending. This is not yet a big issue. It's a serious issue for those involved. It's not reached the level of systemic. But in the supervision, in the warnings that we send, in the looking out for financial instabilities, we look at that and we hope to deal with it without having to deal with the interest rate by pointing to the fact that it's becoming more serious, suggesting to lenders that they have to reduce their focus on this as the next big thing. And when I hear central bankers saying, we will deal with this issue through macroprudential measures, I think they typically mean we're not going to use the interest rate to deal with this issue. And that's another definition of what macroprudential is. It means we're going to look at regulations of the system to do that. Now, I think all of you know of the many changes in the in regulation of the banking system that have happened in the United States. So I won't go through them. They're impressive, and I believe they've made a big difference to the stability of the banking system. And it's gone over, particularly with the introduction of SIFIs, reasonably well. And there's a very strong emphasis on making the big institutions more robust than they had been in the past, and more robust, relatively speaking, than the medium and small size institutions. You know, there are sort of political issues which arise, whether the dividing line should be 50 billion or 100 billion, this sort of thing. But these are the sort of pressures you would expect in any democratic system. What about the non-bank sector? Well, the US has an unusually large number of independent financial sector regulatory bodies. And when I say independent, it means they have the authority to deal with particular issues, and they can't be overridden by another institution. So they're independent in the sense that we central banks like to be independent. So there's an especially great need for efficient cooperation and coordination among the various regulators that collectively oversee the financial system. Only 3 of the 10 regulators represented on the coordinating body in the United States, the Financial Stability Oversight Council, the FSOC, are bank regulators. The other 7 are supervising other aspects of the financial system, including the regulator of credit unions, the SEC, asset managers, and those responsible for derivative transactions. So the FSOC, which is not analogous to the PC, the British Financial Policy Committee, because it doesn't have a central authority there. All discussions there have to reach consensus if they are to be undertaken. There's the belief that the use of the undertake this measure or explain it approach works. That is, it's close to saying everyone agrees this should be done, please do it. And it's worked. It's worked, for instance, in the decision by the SEC to impose certain restrictions on the money market mutual funds, requiring prime money market mutual funds to declare a net asset value which is not necessarily one. That is, to not, for a limited class of money market mutual funds, to give up the claim that a claim on that money market mutual fund is always worth $1. They've also got other aspects of that decision, including a system of gates and fees, about whose operation we'll have to find out more as time goes by. With regard to securitization, which is an aspect, which is certainly a way in which the financial system can become interconnected, there's an important rule finalized last year which will require the securitizers of some assets to retain at least 5% of the credit risk of the assets that collateralize the securities. This is skin in the game. Now, there were two things that happened on aspects of these transactions. One is that on skin in the game, there was some change in the law that enabled the banks not to hold skin in every game, but on certain restrictions and certain transactions not to have to hold any skin. The other transaction in which the other code word for another transaction where there was political, where the legislation was reversed is the swap push-out rule. That's another thing. They're two separate things. In both cases, the regulations were changed in ways which were accepted some of the complaints of the banks about the changes that had been made, but left some of what had been some of had been in the law, left it in the law. So there was a compromise on those things. So these things are helpful, but the non-bank sector keeps evolving. In fact, as an institution or as a group, which is driven in part by responses to things that can't be done in the banking sector that get moved out, it's bound to be a relatively rapidly evolving sector. And there are two particular problems in that regard. Open-end mutual funds and exchange-traded funds now hold a greater share of debt. Each of these say their assets are redeemable immediately. The underlying assets are not, in some cases, especially liquid. And there's a considerable concern that it could be that come a crisis, there could be something analogous to a run on institutions like that. And the same with a very large, with some very large institutions which are asset management, asset managers. And they too make promises that this can be redeemed in a situation where you know that there could in fact be a run on securities of that sort. So there is, the FSOC has put out a request for comments on the potential need to possibly require, just to regulate the asset management companies, possibly by holding cap, possibly by imposing capital requirements, possibly by imposing liquidity requirements. They, of course, do not want to do it. They say they've never had a problem. The we've never had a problem phenomenon is a very tough one because frequently, just when you think a danger has passed, you see it showing up a few months later in some adverse circumstances. So I don't know how many times I've heard this, but for instance, mortgages. We've never had a problem with mortgages, say the banks in some country. Well, they haven't, but they've never lived in an environment with a zero interest rate either. So you have to ask yourself why, how people manage to avoid not having a problem so far. I do believe that the non-bank sector is less vulnerable than it was during the global financial crisis, which is not to say by any means that the United States authorities have tamed the potential problems that could occur in the non-bank sector. So let me mention three problems. First, wholesale funding markets. There have been some improvements in the plumbing of money markets, but many non-bank financial firms, including hedge funds and broker-dealers, continue to rely on secured short-term funding to finance their activities, many of which involve longer-term and illiquid assets. This is a maturity transformation that remains a key vulnerability, and that one has to try and do something about. The Financial Stability Board is proposing an international framework that relies for margins on securities financing transactions. It happens that in the division of power among the regulators in the United States, the Fed has authority to impose margins across the economy, including on transactions that it doesn't otherwise regulate. So this is something which would certainly help the Fed. Well, I say help. It'll certainly help the Fed be important in trying to stabilize, and it'll certainly help the Fed in getting lots of noise about doing things that are imposed at just the wrong time and all that sort of stuff. But that is possible. Secondly, we have to worry about, as this is something I've already mentioned, we have to worry about trends in the financial system that may pose risk to financial stability. And there we're looking at the asset management industry in particular, plus mutual funds and exchange traded funds on which the FSOC is proposing to move, at least has asked for comments on whether it should move. And third, there are areas of the non-bank financial system into which we have a very limited view. That is, we don't know what's going on. That is, if we don't fully know what's going on, that is to say that the data are highly imperfect. The data on hedge funds has improved, but we still don't have a complete picture of the scope and size of hedge fund activities. At the aggregate level, they're not particularly huge, but that doesn't mean that one could be complacent about that. And we're also looking for much better data on the derivatives markets. So these are things which we need to get moving on. The Dodd-Frank Act set up an Office of Financial Responsibility in the Treasury, and an important part of its job is collecting data on, is improving the data on the financial system. So to conclude, the US financial system has changed a great deal over the past several decades, but particularly during the crisis, following the crisis. Over the past several decades, one of the most important changes in the United States system has been the rapid growth of the non-bank sector and it is not an innocent, non-crisis related sector. It's a very important sector, both in terms of the financial activities it undertakes and in the vulnerabilities which we have already seen in the dynamics of the global financial crisis and earlier too. Now, there have been many changes in regulation since 2008, and they've been adopted for both banks and non-banks. But regulation is a cat and mouse game, and so regulators' job is never done. You do something and the other guys aren't going to sit still. They'll figure out what they're still allowed to do and do more of that. And things which are small sometimes become big. So regulators have to be ready to respond to existing regulatory gaps and to keep pace with further changes. The challenge for regulators is to keep pace, is to do that, and we hope we'll succeed in doing so. But we also know that there are threats to stability out there. Where is there? There is the place you're not looking at the moment. Those are the things we haven't yet identified. And a key to success will be to maintain and strengthen not only our ability to identify upcoming threats, because we'll never get that totally right. The key to success is to strengthen the robustness of the financial institutions and of the financial system as a whole. Thank you.